Private equity investments are typically locked up for many years, which means investors don't know at any point in time how much their stakes are worth. Should they take at face value the valuations that PE firms provide? Welcome to the Chicago Booth Review podcast, where we bring you groundbreaking academic research in a clear and straightforward way. I'm Hal Weitzman, and today I'm talking with Chicago Booth's Steve Kaplan, who has detected patterns in private equity valuation reports that reveal whether the company will be sold at a premium or when that exit might happen. So how can investors get a better sense of when and how big their payoffs will be? Steve Kaplan, welcome back to the Chicago Booth Review podcast.
Great to be here, Hal.
So we're here to talk about private equity interim valuations. All right, so let's maybe start with this question. What got you interested in this? Well, what are we trying to solve? What is the question animating this research?
So it's actually very topical now that when you look at private equity investments, whether buyouts, venture capital, whatever, they're illiquid. And so it means there isn't a market price for them necessarily. And so when you're an endowment or a pension fund or whatever, you have these investments and there's some question about what they're worth, as you said before. And today, particularly given the fact that there has been less liquidity, fewer companies have been sold, there's a real question about the valuation. So it's a very interesting topic today because people are not sure of the valuations. And it's an ongoing topic because if you're running a pension fund or an endowment or a family office and you own private equity, you kind of want to know what it's worth. So that's number one. Number two, if you are trying to decide, should I invest in a private equity fund that has come to market, part of the way you make that decision is you look at their past performance. And their past performance is the performance of their fund that they're currently investing. And so you'd like to know what that's worth. It may be marked at 100. If it's really worth 120, well, that's a better fund than you think. And if it's really worth 80, then you might not want to invest in it.
Does that mean that, so if my retirement fund is invested in private equity, and by the way, is it? I mean, is that typical?
Your retirement fund, probably not. Right now, most of the retirement plans are in liquid assets. So whether it's the S&P 500, the total market index, in fixed income, those tend to be liquid assets or assets that are traded, so you can get out. Now, that's also something that's controversial about whether individuals can put more money into private equity, because it started out as an institutional market, an endowment market, and as that market has matured, so that the private equity firms have gotten pretty much as much money out of those sources as they can, they're looking for other sources of money, and so they're trying to get money, they're now approaching individuals and trying to get private equity investors more from the individual market and also potentially the retirement market.
Okay, but as you say, the challenge is I don't know at any one time if I've invested. I don't know at any one time what that's actually worth because it's not marked to market at any moment.
You don't know what it's worth, and also you don't have liquidity. So if
if
you retire and you need your money out, how do you get it out? So that's
And what's the typical time frame, Steve?
So when you invest in a private equity fund, contractually they have 10 years. So they basically there's a 5-year period to invest the money. So you don't, if you commit, let's say you commit $1 million to a fund, they have 5 years to ask you for the $1 million. And they could ask it all in the first year. They could ask it, equally over 5 years. They could ask it toward the end. So you're basically committing to give the fund $1 million over 5 years. And then the fund has at least 10 years to get your money back. And usually they're given they're automatic extensions of 3 years, so they have 13 years. And in practice, it usually goes beyond that, I think the median fund life for data funds raised before the great financial crisis were like 15 years. And we'll see whether that goes longer. The funds that were raised in early 2020s, which have not had good realizations, maybe longer. So, but in any event, I think if you make a private equity investment into a fund, you should expect 15 years.
It's so interesting, though, because, there's always speculation, or there has been for many years, about private equity performance and whether it's peaked. But what you're saying is we won't know that for quite some years to come.
You get a sense of it. So this is where the marks are interesting, and this is why we did this paper, is that the funds that were raised really through 2015 now are pretty highly realized. They're not completely realized, but they're largely realized. So you can look at the performance of those funds, particularly buyout funds, and be pretty confident that that's the fund performance, because a typical investment in a company lasts 5 or 7 years. So the fund, you may take investments over 5 years, then you sell a bunch, and then the ones that last the 15 years are the ones at the end that you haven't sold. So it's sort of like the amount of the fund, or the percentage of the fund that's still outstanding in the 15th year, is small, but it's not zero.
Okay. So, and as you say, that it's not like we get no information as an investor. You do get some. You get
Correct.
These interim valuation reports. How frequently are those issued?
So the interim valuation reports you get every quarter.
Okay, so every quarter. So just like having a public company report. And so what is in these reports? Why are they important? Well, they're important, I guess, because you get the valuation. But what is in them?
So what's in them is they tell you their estimates of the value of the existing investment. So every quarter you'll say, okay, you got these realizations, and if you got a realization because you get a check, and you get a notice that you're going to get a wire from the fund. And then at the end of the quarter, they'll tell you, at a minimum, they'll tell you, here's what the fund is worth, and here's what the individual portfolio companies, what we're marking them at. Some funds give you a lot more information. They'll tell you the revenue, they'll tell you the operating income, they'll give you some color into what's happening in the company. So, and you tend to see that particularly on the buyout side, where they'll give you pretty interesting information about the companies. And the venture side, sometimes you get that, sometimes not, but you'll always get a valuation of the individual companies.
Okay, and so in your research that we're going to talk about, you were analyzing whether these interim valuations, how they can predict the final outcomes and the exit timing. So what is the sort of headline finding here from this research?
So the headline is that the pattern of how individual portfolio companies are valued is informative. And what that means is, if you, let's say, the private equity fund, invests in a company, and initially, let's say invests, $50 million. Initially, it's marking that company at $50 million. Then let's say a year later, it says, oh, things are going well. We mark it up to 55. And then the next year, we mark it up to 60. When you see that pattern of markups, that tends to be good, that they undermark the companies that are doing well. On the flip side, if you see them marking a company down, like it was 50 and then 45 and 40, that's bad. They tend to undermark it down. And then the thing that's actually quite interesting, if the marks are flat, so it's 50, 50, 50, 50, that's also bad. You tend to see those will underperform going forward.
Is that because they're in denial?
It's a funny thing, because they're kind of in denial on the upside, right? They're conservative
Well, they're
on the
being
upside.
conservative.
They're conservative on the upside. They're conservative on the, I would just say they're sort of conservative. And historically, when you add that all up at the fund level, they undermark. So historically, that if you look at where a fund is marked at a particular point in time, that tends to undervalue the fund going forward. Now that was true in a period where things went well, and so it'll be interesting to see whether that continues. Post 2020, the data for that was pre 2020, particularly since I think post 2020 there are more companies that have been marked flat.
Is that the general trajectory of private equity as an industry, that more stuff is getting marked down?
Well, what is the case is if you look at both buyout and venture, and particularly venture, that the marks, at least relative to how they were doing relative to public markets, peaked in 2022. And because there was this great run in 2020, 2021 of selling things, and there's also a lot of buying. So there's a lot of transactions in 2021 when private market prices were very high, particularly on the venture side. And since then, valuations on the venture side in particular have come down.
But not so much that they're in line with public markets. You mean just that they've lost their edge?
I don't know. I'm not sure about the actual, relative to public markets.
Okay, but private equity is not, at least in general, is not as healthy as it was a few years ago, it sounds like.
I would say that the returns, private equity, had this huge streak of every year, if you bought the average private equity fund, and talk buyout funds in particular, if you bought the average buyout fund every year, you beat the S&P 500. So it's true like almost every year from 1992 to 2019. And that's why so much money went in. The 2020 vintages are running kind of about the same as the S&P, maybe a little lower, and the 2021 vintages a little lower on the buyout side. The venture side is much more up and down. They did very well, say 2010 to 2016 vintages. And since then, they're not performing as well, and the 2020 and 21 vintages are underperforming the S&P by a decent margin. So you've got this time period where the vintages, all the funds raised on the venture and buyout side in 20 and 21 are going to, have a tough time, beating the S&P 500.
Steve, in the first half, you talked about your research into private equity interim valuation reports and how the pattern can often tell us something. If the general pattern is being marked up, that's a good sign. If it's being marked down or it's being marked flat, that's a bad sign typically. You, instead of looking at kind of just how the entire PE fund is performing, your study focused on the individual portfolio company investments. Why did you go down to that granular level?
Because other people have looked at the fund level, and the fund level, there's not a ton of pattern, particularly on the buyout side. So the buyout side, you can look at how the previous fund is performing. And so this is an earlier paper I did. So let's say a firm is raising, Fund 3. Let's look at Fund 2. Is Fund 2 performing well, or medium, or badly? Turns out, if you look at that performance when they're raising Fund 3, Fund 2's performance tells you nothing. And so that's on the buyout side. The venture side, it tells you something. The top performers persist, and that's venture is unusual, if not unique, that way. So that's the result on the at the fund level. And there are a number of papers that try to look at that. No one had really looked at, or is there very little looking at the actual company level and whether you could learn something there. And so that's why it was a natural thing to look at, as we were able to get data to study that.
Okay, and then so beyond just looking at the most recent reported value, in this paper you talk about two specific measures, which I think we've covered. I just want to make sure. So staleness is one, and markdown frequency is another. So we talked about the trajectories, but what is staleness and what is markdown frequency?
Staleness is just you have the same valuation every quarter. So you make
So
an
staleness is
investment.
bad, as it sounds like.
Staleness is if you invested at 50 and you keep it at 50, that's more likely to go down than it is to go up.
Okay, so staleness is bad, which is what we would assume. What about markdown frequency?
Markdown. So if you go from 50 to 40 and then keep it at 40, that's not as bad as going 50, 45, 43, 40. Because 50, 45, 43, 40, you got 3 markdowns. 3 markdowns is worse than 1. That's what markdown frequency is.
Okay, all right. So both of those are bad. What about exits? So what is the significance of those, of staleness and markdown frequency in terms of the timing of an exit? So, for example, did staleness mean an investment was sold sooner rather than later?
So they also they do similar things as you might imagine, that when an investment is stale, it tends to be sold later. When investment has been marked up, has markups, it's going to be sold more quickly and at higher valuations. If it's stale or there have been markdowns, you tend to put off selling them. And when you do sell them, the outcomes are not as good. So it's not just amount; it's also time.
It's the timing,
yeah,
right?
Yeah.
So they tend to hold on to bad investments in the hope that things will turn out better?
I would guess that's correct.
It's kind of like selling a house that you it's hard to depart from the value that you have in your mind. So you kind of might hold on to it for longer.
Right, and you're hoping you can make it better. You're hoping it'll improve,
but generally the market doesn't turn around. I feel like there's a general lesson there, Steve, in terms of investments.
That's the interesting thing right now, because as I said, the 20 and 21 vintages, there are a lot of companies that haven't been sold, and my guess is many of them haven't been written down. They're stale prices, and so you'll probably see this pattern will continue going forward.
Okay, so staleness cannot be. It's always going to be a bad sign.
Historically it is, and it need not be, right? You could imagine some people will just keep it the same, and then we'll sell it. It'll pop up, and that could happen too.
But at times of less liquidity, when you have even less liquidity, do you have more staleness?
There's more. I think the answer is actually I'm not positive from the data that that's the case, but I'm pretty sure that that's the case. Is that the marks now are staler than usual because people don't want to write. They can't write them up because they haven't improved, but they're not willing to write them down. So I would guess that's the case. But that's something that we can we or somebody else will study going forward.
But we're in a period now that looks somewhat stale. Is that right?
That would be my guess.
Okay. So how useful, we talked about interim returns, staleness, markdowns, how useful are all these measures for predicting the sort of negative tail outcomes like losing money on investment, being in the bottom 25%, and then positive tail outcomes like making, 3 times the investment, being in the top 25%?
Yeah, they're statistically significant and reasonably strongly. And where you might use that is if you're an investor looking to invest in somebody's next fund, you want to know how that fund, the previous fund, is really doing. Well, if there are a lot of stale investments in that fund, I'd be a little nervous and worry that performance is actually not as good as they say. On the other hand, if there are a number of funds, number of companies that have been written up a little bit, I'd be saying maybe those things are undervalued, and that would affect my investing in the next fund. And then also, of course, there are a lot of secondary transactions where people are the original limited partners, pension funds, endowments, want to sell some of their private equity investments. Harvard, was just sold, and Yale, I think, have just sold parts of their private equity portfolio. So if I'm buying that portfolio and buying funds in that portfolio, I actually want to see how those individual companies are doing. And again, if there are a lot of little write-ups, that's good. there are a lot of staleness and write-downs, then I'm going to want to put a bigger discount on that. So it's potentially very useful. And a funny story, one of my co-authors, Ege, and I should say this is co-written with Ilya and Ege, who are both at Stanford. Ege presented this, and afterward, one of the people in the audience was actually someone who was an investor in secondary transactions. And he told Ege, well, my alpha just went away because you just told people how I figure out whether the fund.
This was the special sauce you're giving away.
Exactly.
That makes me think, though. I mean, the way you've described it is quite straightforward. Like all great research, there's a pattern there that we can detect. If there's an individual investor who is, I mean, am I able to access previous interim valuation reports?
If you're a pension fund or family office, whatever, endowment, you get, you can ask the general partner, the private equity fund or venture fund, what's going on in your portfolio, what's happened over time. Absolutely. There's a data room usually, and all this information is available.
Okay, and past performance does suggest that I can derive some knowledge from that about the current valuations.
Mm-hmm.
Okay, so if anybody's listening who actually is looking at private equity, it looks like it's fairly straightforward according to your research to work out what the valuation, what an accurate valuation is, or whether what they're telling you is accurate, and then what that means for an exit.
Which way it's likely to go. Absolutely.
Okay, Steve, this may be I know you're not a financial advisor, but is private equity right now a reasonable investment?
So that's a very there's a very long answer to that. So private equity has a lot of components. You've got venture capital, you've got buyouts, you've got infrastructure, you've got real estate, you've got private credit. And I would say different things about those different asset classes.
Let's just take the two that you've mentioned most frequently, buyouts and venture capital.
So venture capital, early stage venture is, I think, still attractive. And why? Again, you want to be, there are a lot of caveats there because of who you can actually invest in. But as an asset class, the attractiveness is there's a huge amount of technological change. You've got AI, and that's going to do, all kinds of things in many, many industries. And there's not a huge amount of money that's been raised lately. It's sort of a reasonable, it's not sort of a feeding frenzy like it was 5 years ago, 4 years ago. So I think early stage venture has some attractiveness. Later stage venture, not so much for a variety of reasons. And buyout, I would say the same thing for middle market. So again, for those smaller deals, I think there are many deals to be done. There's not the same huge amount of capital. Fundraising has not been, has been sort of average. It hasn't been extreme. And there are opportunities. I think the larger funds are a little hampered by not being able to sell. Again, it's liquidity. So, but both venture and buyout, the middle market and early, I think are attractive. Real estate has performed poorly for many, many years. I don't see a lot of value added there. I wouldn't put money in real estate funds. And I can go on, but I'll stop there.
Okay, no, that's terrific. Great advice. All right, Steve Kaplan, thank you very much for coming on the Chicago Booth Review podcast and giving us the ingredients for the special sauce that goes into the private equity valuations reports.
Very good. I should add one thing. Now that I've given you advice, I have a 50% chance of being right.